So let's say we came and tried to understand what it is that technical analysis sees in a chart as far as candles goes. That's our video today about candles, what it is, how do they work, and pretty much what advantages you can take when you have candles on your chart as far as price action goes. And let's get right into it. So if we were to look at a candlestick in general is a body, a lower wick, a higher wick, and it is conducted of four different parts. You have an open, a close, a lower wick, a higher wick. An open, a close, a lower wick, a higher wick. You know, open, close, lower wick, higher wick. Keep doing it all the time. So that's exactly how it works. You have an open, a close, a lower wick, a higher wick. You have the body, lower wicks, wicks. You have a body, you have a wick. Sometimes you don't have a lower wick. Okay? So when you are coming to look at a certain pair, and for example, this is gold. This is the 5-minute. These are 5-minute candles. 5-minute candle, 5-minute candle, 5-minute candle, and it goes on. It's just the amount of price action that happened in 5 minutes is what you see. So for example, you have a bearish candle. This is a bearish candle indicating bears are controlling this 5 minute. You have a bullish candle indicating bulls are in control in this 5 minute. Then you have, for example, something like this. This is a pin bar candle. This is undecision candle, it's called. There's a equal and opposite amount of buying and selling, or there is no buying or selling, so price has not moved in that 5 minutes. Of course, in reality, price is always moving, but as far as 5 minute goes, there was not a lot of action that happened, hence no price action. So usually most of the times once you see something like that, something like this, you do not want to enter a trade based off of this. You would rather enter trades based off of something that has to do with a no supply and no demand. So for example, let's go back to somewhere where I already have this drawn out so we don't have to look for them. And so for example, we were in an up move here. Starting here, you can see bulls are in control here on the 5 minute. Look, 5, 5 up. Bears came in but could not have a price drop below these candles. You had the first bears come in here, bulls came back up, bears came back in, pushed down. They still can't break though. Bulls came back in, bears a little bit here, a little here again, still can't break. If they would have broke this, more than likely they would have tried to get a retest down to here, but they could not. Bulls were stronger, kept on pushing it up. Again, same concept, push up. The market works not by going straight up or straight down. The market works in waves. So you'll have a push up, a wave, push up, wave, push up, stronger wave, push back up. Now what happens is now you're starting to get undecision. Who is control? Nobody knows until you get price reactions. So you can see push down, push back up, push down. Now let's get into little details as far as what it is that you would look for if you are trying to trade a 5-minute candle at a certain zones. So the zone issue about supply and demand zones. I'm not going to get into too much details about it, but these are the types of things that I look for when it is to enter a trade. So let's say you had a uptrend, and that uptrend is starting to get weak. So you have an uptrend, up, an uptrend is consisted of, or a downtrend. An uptrend is consisted of higher highs, lower lows, higher highs, lower lows, higher highs, lower lows, higher highs, lower lows. This is an uptrend, as you can see. The thing is once it stops becoming an uptrend is once you break that low. So for example, it started to happen right about, I would say in this area right here, because we had a higher high, now we have a lower low, we have a high, but not a higher high, a lower low, started right here, you can see. Okay, we don't really enter the trade here, but it started right here. Now we're looking to see if there's going to be a short position coming up. So what it is, when I take a short position, if you take anything from this video, understand this about how it is I take a trade. So you had a push back up into this demand zone, which I will discuss in a later video. Over here, because we had the high, we came into here. What is happening now as we reach up to this area? We're having volume kick in, but price is not really reacting high to the upside. You can see a push up with a long wick. This is exhaustion, which basically means that bulls are exhausted. They're pushing with as much, I would say, liquidity, as much volume bars, as much whatever it is you want to call it. They are pushing and exhausting their resources to push up to as high as price they can. But the thing is bears know this, so they are starting to sell. So as they come in and start to sell, you look for reactions. So for example, started here, they're getting exhausted because they're not really breaking the high for a stronger push in, nothing like this. Bulls are controlled here, but now they're really starting to lessen their control. So you can see you get a push up, and as price keeps trying to make new highs, bears are coming in. Push up, pin bar, sign of indication that undecided buyers are no longer buying strong positions. So they're either closing out their positions or no longer buying. And you can see bears come in, they start to push down, and then you can see last attempt by the bulls. Right here, bears are trying to push it down. Last attempt to get out of their positions. Volume kicked in again. Not a strong volume, but it still kicked in. Then what happened was you had a no demand. A no demand is, I will discuss no demands and no supplies in depth, just like I did in the previous video, but more now for beginners to understand it a little bit better. I've already discussed it in a previous video. You can check it out on my channel. It's called No Supply, No Demand bars. And you can see that the volume bar is lower than the previous two. You can see right here you don't enter the trade until you get confirmation. A confirmation candle for me is always the close. So the close on the 5-minute for me is the confirmation. Other people trade it, for example, on the 1 hour is their confirmation. Other people trade on a higher wick as far as their confirmation. I like to trade closes. It helps me out to stay more disciplined than it is when you're trading high and low wicks. So for example, you had a close right here, this is confirmation, you enter the trade, and basically we get a good push down. Price starts to, structure itself out as far as bears are taking positions. As we go up, we get a sell. As we go down, bulls can barely push it up. That's what it is you gotta look for. Stick to this key detail right here. As you go up, bears come in. As you go up, bulls can barely push up. Bears are way stronger. Do you understand? It's about who is stronger in the market as far as when you're taking price action goes. We are not investors. Investors is a whole different ballgame. Please, everybody, try to get that mindset away from you when you hear things on news outlets and other media. There's a difference between investors and traders, a big, big difference. An investor will tell you, for example, let me just show you. Investor will tell you gold is at a low. It's time to start buying. It will go back up to $2,000. This is an investor. A trader will tell you, for me to buy, I would like to see a trend direction change because bears are in control. If I see a trend direction change, I will start to buy. That's exactly what it is. It's a big difference. Bears, investors will buy pretty much at different levels. So they'll buy at different levels. So they'll say, for example, they'll say, I'll buy gold if it reaches 1850. And they'll buy. Or I will sell gold if it reaches 2000. And they'll sell. So this is where we don't want to get the two mixed up. So again, when you're looking at candles, you want to check when you're entering a trade, what are the reactions happening as far as the next, if you're looking to short. I personally don't like to buy, it happens though, don't get me wrong, but I don't like to buy the highs and the lows, because when you buy the highs and the lows, it's correct, you're getting the highest price for a short position, or you're getting the lowest price for a long position. But the problem is with this, the majority of the time will not be able to spot the high. I would say about, not 90, I would say about 80% of the time you will not be able to spot the high of that day or even the week, because institutions are more understanding of the market than you are, and they have more liquidity, so they can do things like this. So for example, do you see this 5-minute candle? This is a big push down. Could you be, with all honesty, be able to predict that it's going to stop right here and it's time to go long on this position? Very unlikely. Very, very unlikely. So what it is that we look for is we look for reactions. We don't look for, oh, when gold reaches this certain point, I want to buy. That's not how trading works. You want to look at things like this. Where's the reaction? You had push down, a lot amount of volume came in. Now, what you want to look for is this. You want to look, is there less volume getting pushed to the downside? There is. Now there is more candlesticks getting bought to the upside. So now you have more green. Correct that you have long wicks getting pushed down. This is push down, push down. So there's still realistically not a strong long position or not a strong buy position. You can take risky trades. Don't get me wrong. You can take risky trades. Of course, always protecting your position. So let's say, for example, you had this no supply. You had a push up confirmation over here, right on this close, because now we closed above it and above all three of these candles. So now bulls are really in control. So let's say you took this position. The only issue is you got to be a little careful as far as what risk you're willing to take on this trade. So a better risk would have been if price comes back below this position, you would like to get out, because it looks like bears still want to push it down. more than likely they will not stop here, because if it breaks this, that means it broke the closes. This is why closes are very important. The close of a candle is important more than the wick. When you are trying to enter a trade and confirm the trade, big institutions are trading line charts, and they also have other people in their institution trading candle closes. A line chart are candle closes. So let's say, for example, you had a line chart for a 5 minutes. You would have something like this. Do you see this? These are all closes. So once you have reactions like that little reaction right there, that's a close. That is a push. So this is what they're trading. So I would more say a better indication for you to learn about is 5-minute candle closes, not wicks. Wicks does help, but it does confuse. It confuses a lot of people, and they will take bad trades based off of, certain positions that they look out because of the wicks. So again, another key indicator you would like to look at is, let's say you are first starting. Of course, start with a demo account. Do not start with real money if you don't know what you're doing. And there are three main candles that I will look for to enter a trade on a stronger position, on a higher amount of position. One be that hammer candle. This is a hammer candle. A hammer candle is only as good as its next confirmation candle. So, for example, you have this hammer candle right here. Confirmation is very close, but not yet. Confirmation is right here, because we closed above it, above the previous candles, wicks, and another entry would have been right here. Hammer candles are a good sign that a trend is stopping. So this is a hammer candle, or an inverted hammer candle is something like this. This is an inverted hammer candle. This is a hammer candle, but to the upside with a bearish reaction. Okay? So I would recommend whoever wants to learn about specific different types of hammer candles and different types of Japanese candlesticks. That's exactly what they're called. They are called Japanese candlesticks, created by a Japanese man, and I think it was the late 1800s. That's how long they've been around. So they're not some kind of new technical analysis thing that came out 30 years ago or 40 years ago. This has been over 100 years that they've been around. So that's one of the candlesticks. So it's a hammer candle. And another candle that I would look for that tells a sign of bears or bulls no longer strong is an engulfing candle. An engulfing candle would be something like this. This is an engulfing candle. So, engulfing candle, there are different rules for it. Different people set different rules. I set for my personal rule. When I'm telling you guys something, I set these rules from my personal self. So I'll be disciplined about it, and I will not conduct the trade just from my experience. Based off what I've seen, I will not conduct the trade unless it does this rule, which for an engulfing candle to me is a strong, big-bodied candle, with a close below at least four candles. So you have 1, 2, 3, 4. You had more, don't get me wrong, but at least 4 candles. That is, for me, a strong engulfing candle. Now, you could see, for example, a different engulfing candle. For example, right here. This is another strong engulfing candle. You had 1, 2, 3, 4. For me, this is confirmation that bulls are in control. This is confirmation for me that bears are in control. So I would look to short. Of course, confirmation comes on the next candle. If I were to get a bullish candle right here and I get a pushback up, I'm not entering the trade. If I get a bearish candle right here and the close right here, I'm not entering the trade. This is being disciplined about your chart and about your charting. Do you understand? As far as engulfing goes, you need the candle to close above the wicks also. You have to. You have to have them close above the wicks. That means all of this, whatever happened here, negates it and is no longer valid. So even this push down right here, this is no longer valid, this push down. Bulls are in control because they closed above it. This is a long video, I understand, but candlesticks, you can talk about it. Literally, I think probably at least 100 episodes, 20-minute longs. I'm not joking. There's books of like almost encyclopedias about candlesticks. It's pretty it's pretty big. But yeah, this is I hope you guys like this video. I know it's a long video. I'll try to later in the future start to shorten these videos if people are not liking them. You can listen to these videos as you are pretty much conducting some other thing in your life. You don't have to always be focusing on the video. Listening is more key for me. Focusing on you're letting your mind comprehend things is more better than me than visualizing. So again, peace out. Please comment, subscribe, and like this video.